Hey guys, I'm Rob Tetrault from robtetrault.com, head of the Tetrault Wealth Advisory Group here at Canaccord Genuity Wealth Management. I'm pumped today. We got a fantastic guest, good buddy of mine, Cam Goodnough. And I mean, we tried to get someone else, but he's good enough for now. That's a joke. Really excited to have him here. We're in Winnipeg. He's in town. Not every day we get a CEO of a publicly listed company on the TSX in town, chatting in our office in Winnipeg. We're thrilled to have you here, Cam.
Thanks for having me.
Yeah, it's our pleasure. So today we're talking about private debt. We're going to talk a bit about private debt. We're going to talk about your story a bit. I want to hear how you got involved in financial services. I want to hear about Timbercreek, their role, how you see it fitting. And really, private debt has changed a lot, I would say, in the last 10, 15, 20 years, even 50 years, where it's a lot more available now than it ever was. And we'll talk about that in a sec too. But let's talk about you and how you started in the financial services industry. Where are you from originally?
Town's called Smithville, Southern Ontario, small town, about 2,500 people. My parents were both from Saskatchewan, and it was great. It was kind of a Huck Finn kind of existence until you were about 14 or 15, and then all you want to do is get out of that town. My travels took me to university. I went to the University of Windsor, got my undergrad in commerce. Ultimately, still didn't know what I wanted to do with my life, as I think you're pretty young and you're still figuring things out. I ended up going to do my grad work at my MBA and my law degree at Osgoode Hall and Schulich at York University.
So that's an okay university, but I went to U of T. It's a little better for my law school, but anyways.
Thank you. And that's where I found out about investment banking. Coming from where I came from, it wasn't a topic of conversation around the kitchen table, and it was at that school at that point that I found out about investment banking. Started exploring what that meant, what that would look like, and that was my start in financial services. Out of school, I joined Merrill Lynch in their corporate finance group, and back then, late '90s. Spent a lot of time on technology and technology IPOs, and that ended at the early 2000s. Had to reinvent myself in at that point.
So you were actually an investment banker late 90s with the tech run up and the tech wreck?
Yes.
Oh, that must have been really exciting.
It was, you're working on some fantastic deals, some really interesting companies. You'd have story. I mean, not necessarily want to dive too deep today, but there were some ludicrous things that were happening at valuations and multiples of number of engineers in terms of figuring out how do you value a pre-revenue company, and you really opened your eyes, and that really set the foundation for me around value. And what is it that I'm paying for, and what am I really getting for what I'm paying for? And that has stuck with me. So in 2001, when you had the start of the collapse of NASDAQ, I needed to figure out for myself where, and I was still young at this point and mobile in terms of profession and in terms of focus area, there was an empty seat available in the financial services area of the firm. So I made the move from technology, pre-IPO financing stuff to financial services. Spent a lot of time digging into banks and insurance companies and wealth managers, but I really found an affinity for wealth managers. Particularly when you were covering somebody who was a really good investment professional who understood value. Speaking back to my lessons of through the tech bubble crash, whatever you want to call it, and that was really my start and my introduction to not just private debt, but just wealth management generally around the different asset classes. How does this strategy work? How does that strategy work? What are the pros and cons of the various strategies?
Were you like advising wealth advisors, or were you a wealth advisor at that point?
At this point, I was advising the companies themselves.
Okay.
So, whether they're publicly traded like a CI or a financial, or whether they were private companies, we were delivering them whatever financial services they needed, in terms of fund launches or in terms of capital market needs,
okay.
Raising debt, raising equity, mergers and acquisitions, that sort of thing. And that really, fueled my interest in the space. At this point, I'm now at RBC. and then ultimately culminated my career at TD. At TD, I found this young company called Timbercreek. And they were small, and they weren't particularly well covered by the large institutions. And I got to really know the two founders there, spent a lot of time with them, started raising them capital for the predecessor funds to Timbercreek Financial. And ultimately in 2016 advised them on the merger of a couple of their companies that formed Timbercreek Financial. And it was out of that Ugo and Blair talked to me about joining Timbercreek. For me, at that point, having spent 17 or 18 years in investment banking, it was a chance to do what I'd been on the other side of the table, what I'd been advising others to do.
So now you're CEO of Timbercreek Financial. It's 2016.
Yes.
At that point, Timbercreek Financial has a focus on private debt exclusively, correct?
Correct.
So what's your view on it, and how what are the first things you do with respect to Timbercreek?
Well, the first thing that we did was assess the risk in the portfolio. That to us is a fundamental tenet. We felt that where we were in the real estate cycle was probably later than earlier in terms of what inning are we in, and so we started de-risking the portfolio. What that means for private debt, we're a commercial real estate lender, so all we do is commercial real estate. We don't do single family residential mortgages. We lend, our sweet spot is between $5 and $50 million. We love apartment buildings.
What would be the loan to value that you'd be doing on these projects?
Our average portfolio is about $1.2 billion. Would be 67%.
67%, and is this exclusively mezzanine financing, kind of short-term stuff?
It is short-term, but it's not mezzanine. It's first mortgages. So we're providing first mortgages to companies, real estate companies, who are transitioning an asset from or executing a value-add strategy. Either one, you can call either one. So they're looking for a short-term bridge solution to take this property from point A to point B, or rather the other way around, take a B asset and make it an A asset, or a C asset and make it a B asset. And at that point, we'd get taken out by traditional financiers who have a much lower cost of capital than we have, or B, a sale of the property in which we get repaid. So our typical mortgages are 2 years. Our average duration in the portfolio, ranges, but 1.1, 1.2 years.
And this private debt has been around for a while, and it serves a ridiculously important purpose, because these developments don't happen otherwise, right? Like, you got a building that needs to either expand or maybe scale up, add some stories. I'm thinking maybe in Toronto or in Vancouver.
Absolutely. Repositioning them, renovating them, leasing them up if they're under lease or under market rents. And so, historically, this activity was done by the financial institutions. But there was, as the regulations have evolved, they need to hold more capital against certain kinds of projects versus other kinds of projects, and it creates an opportunity. And that opportunity that was created, you've seen a number of entities created over the last 20 years, but really heavily the last 10 years, that are focused on providing private alternatives for professional investors to access debt capital while they're executing the projects. And so, our niche, I've talked about some of the stuff and our differentiators. We are flexible. We don't have 10,000 mortgages. We have 125, 150 mortgages. So we're flexible, and we're customizing mortgages each time to the borrower's needs. We are a real estate company first and foremost. We understand the real estate. We're a financial provider secondarily, meaning we're making an assessment on whether we like the real estate, and if a downside scenario were to occur, would we be happy owning this at our loan to value ratio?
Which is very important.
The LTV, and could we complete the other part? Could we complete the project that's being done? So, do we like the property? Do we like the sponsor who's behind this project? And thirdly, do we like the plan? Do we believe that we need more apartments in Winnipeg? Do we believe we need more office space in Toronto? Whatever that is, if we agree with the thesis and we have faith in the sponsor, And first and foremost, have we felt and touched and walked through the actual real estate and we like the location? If those things all tick, that's a project that we can get behind at the right LTV level.
Okay, so now you've been CEO, fast forward a few years, you're CEO, you're running Timbercreek Financial, the stock is doing well, the stock is yielding, the stock pays what kind of dividend?
On a market price, just over 7%.
Just over 7%. So, the unit holders, they end up buying the stock. It trades on the Toronto Stock Exchange. They buy the stock. In theory, they hold it. They collect the dividend. That's a quarterly dividend.
That is a monthly distribution.
Monthly distribution. You're getting your annual yield, to call it about 7%.
Yeah.
In theory, the stock should, hopefully in your mind, would it grow over time in theory? Is that the plan?
Well, we are what I would describe as, people shouldn't own us thinking that there's capital appreciation.
Right.
We are a yield play. At the end of the day, we are a portfolio of mortgages. We lend $1, and if we do our job right, we get 100 cents back. We don't get 105 cents back. We get 100 cents back. Yeah, and we collected interest on the way through, and we flow all of that interest income out to our investors. So it's literally holding. The investors should think of it as holding a portfolio of mortgages, and they're getting a yield out of it, and that the share price is it's not it's publicly traded, so there is daily ups and downs, but it's you shouldn't be thinking there's a 10% increase or decrease. It shouldn't be that volatile.
Right. I'm glad you mentioned that, because this is not owning real estate, or this is not owning a company like a publicly traded equity where you're hoping to get a yield plus growth. This is a very clear niche.
Yes.
You talked about access to investors.
Yeah.
So when I grew up, you couldn't access private debt like this. This was not possible. You couldn't go out and just buy access to $1 billion, $100 million or $1 billion fund managers that could actually manage private debt for you. So that's now changed, and it's impressive, I'd say.
Yeah, it has changed. The if you think about, the whole world is changing. The particularly post financial crisis, you've had investors who might have not liked that roller coaster ride they're on, and you've had this insatiable drive towards yield and stability and uncorrelated returns. That's happening at all different sophistication levels of the investors. So at the pension funds and the large endowment funds, the Harvards, etc. What are they doing? They're moving towards private assets. They're moving towards owning physical real estate, owning private debt, private equity, infrastructure, energy, and their public components are decreasing. And that capital has allowed, and they need to source that capital. These aren't, this isn't like a stock. We can't just go out and buy a bunch of private debt. We have to have a team that goes and finds these deals and has relationships with the developers and the project managers, and then have an underwriting team that has to go through the credit and make sure that we're satisfied that all the numbers tie, and that all the environmental reports and the appraisals and the engineering reports and everything else is tied down, because again, we're lending $1 and getting 100 cents back. We don't have upside. We don't want to have downside either. So we have to do all of our work, and then finally we have to service that mortgage. So this is we need to go out and make sure we're getting in the interest payments. We're running like in terms of it's not a bank, but it is a component of what a bank does. Banks are much more diversified.
Managing the risk for sure would be an important one.
Absolutely. And so we've got an independent board of directors. We lever who have experience in various facets, from legal to accounting to real estate to other. We leverage their expertise. We leverage the full team at Timbercreek's across the firm.
So you're preaching to the choir here. Not sure if you know, but those who do follow me, either at robtetrault.com or my YouTube channel, they do know that I've been preaching this exact strategy of diversifying outside of asset classes, typical stock and bond asset classes. The big thing for me is uncorrelated assets, right? If we can get an asset class that generates returns, no matter what happens in the stock market, no matter what happens in China, no matter what happens with President Trump, that to me, that's an uncorrelated asset class and something that should be in a portfolio. So who do you see as kind of your ideal investors, or is there an ideal investor?
Yeah, for us, it's the investors that are what we find. The vast majority of our investors are moms and pops who are looking to generate a particular return on their portfolio, who don't want excess volatility in their portfolio. You know, they've got a number in their head. Maybe the number is 5, maybe the number is 7, maybe the number is 9, whatever that number in return profile, and they're using us as a more stable income source and looking elsewhere for either a top up on a capital appreciation or otherwise. But we are a MIC, a mortgage investment corp, and as a MIC, we don't have to pay corporate tax. That's the positive. The negative is that in the hands of the investors, our dividends are taxed as interest income. It's as if they held the mortgages themselves directly, and so it makes sense inside
an RSP. Tax-free savings account.
Exactly.
Yeah.
Anything like that where you can shield that income without having to pay tax on it.
Yeah, for sure. I want to ask you one more question about the correlation to interest rates relative to what you guys do. Is it a straight thing where interest rates go down, your yield goes down, and interest rates go up and your yield goes up, or is it more complicated than that?
It is a balloon. And in the moment you squeeze on one part, another part bulges out, you're squeezing on that part, another part bulges out. There's a correlation on rates in terms of overall real estate activity. So as rates are declining, real estate activity generally is increasing. Now in 2018, we saw 3 rate hikes, 75 basis points over the year, and yet 2018 was a banner year for real estate activity. So it's not necessarily directly correlated, but overall there is interest rates, or it looks like we're back in a declining rate environment again, and that generally has a positive impact on real estate.
That's fantastic. All right, guys, blessed, lucky today to sit down with Cam Goodnough, CEO of Timbercreek Financial. Really thrilled to have him here. Again, long line of quality guests that we have here. Happy to have you. For me, I'm thanking you for tuning in. Again, we appreciate it. Again, I'm Rob Tetrault from robtetrault.com, head of the Tetrault Wealth Advisor Group here at Canaccord Genuity Wealth Management. Give us a like, give us a share, give us your comments. We'd love to hear from you. Thanks for tuning in.